folks, Dan Frio here with your real estate update for October 10th, 2023. Man, this year is just flying. So if you're watching this for a second time today, thank you so much. I took down this morning's video because the context or the audio was absolutely terrible. Don't know what happened, so I'm going to redo my video. But this morning I called it and I said, you know, you're going to see rates probably come off about 1/8 to 1/4%, and that's exactly what's taking place right now. So what's the dynamics behind that? Well, we're going to talk about that in a second. But what I really wanted to discuss on this channel that I try to avoid with all the mustard I have is not talking about real estate, the values and the prices of homes. The reason being is nobody really knows. So when you see mainstream media, the TV personalities, and then you see YouTube personalities coming out there and saying, oh, it's going to crash. It's going to be worse than 2008. It's going to be the worst thing ever. And they're getting hundreds of thousands, if not millions of clicks. But if you really dive into the details of this, well, let's do that right now. CNBC posted this article just this morning, and it's October 10th, like I said, 2023, and they posted this at 9 a.m. this morning. The 11 major U.S. cities where home prices have risen the most is not New York or San Francisco. Well, then what is it? I didn't think home prices were supposed to rise. Well, home prices continue to increase in most of the U.S. major cities. And right through here, we're seeing that the greater Los Angeles has seen almost a 24% increase in values over the last 12 months. That's not normal. The normal appreciation rate on homes is about 4 to 6%. But if you scroll down here, you're going to see in that time, the median home price in the 50 largest metropolitan areas increased 5.76%. That's the normal appreciation rate that we normally see throughout the last 50 years. So where's that crash that everybody's been talking about? Well, if you really understand the markets, and I've been doing this for over 30 years, so I understand, I've been through the ups, the downs, the good, the bad, the ugly, that there is the dynamics between housing crashes and what we're in today is not even related. The 2008 crash was due to subprime mortgages. This basically, the crash we have right now is in the number of units being sold. It's really hard to afford a home in this market. Okay, so in this article too, what you see is the top areas that they're going through. Los Angeles, 24%. San Diego, almost 20%. Richmond, 15%. You scroll down, I'm in Chicago. Yes, I can validate this. We are up 10% over the past year. Now, I'm going to give you guys some information. I'm going to show you how you can research the markets. So to do this, you're going to go over to Zillow. Okay, Zillow is a fantastic database to use. You're going to scroll all the way down to the bottom. What we're going to look at is what are house prices doing all over the country. So to do that, we scroll all the way down to the bottom. Okay, right through here, you're going to see a tab that says research. Let's click the research button. Then right through here, you're going to see data. Okay, we're going to click the data button. And I'm doing this live, folks, so just bear with me. You scroll down through here, and this is going to tell you, if you go all the way to the bottom, there's a lot of analytics in here, but if you go down to the bottom, it's telling you what houses have done so far this year. In 2023, what have home values done? Well, you see through here, do you see Hartford, Connecticut? Do you see any major crashes? I consider a crash maybe down 15, 20, 30%. Well, that's the top of the iceberg there. So let's go down and see what markets are really crashing and maybe the whys behind it. Oh, we see Austin, Texas. It's down 11% so far this year. And the only other person right behind it is New Orleans. And then everybody else is maybe 4, 5, 6% declines. So you're basically seeing a market that's ranging from, about a 5 or 6% increase to a 5 or 6% decrease. So that's the facts, fortunately or unfortunately. So now what we're going to look at is what's going on in the markets due to basically Hamas striking Israel. So God bless those in Israel. Our prayers and thoughts are out to them. But normally, like I said, what happens in a market that we have this conflict, world conflicts, we see the stock market crashing. Well, yesterday the stock market was up over 200 points, and today it continues that rally up another 129 points. But what we focus in on this channel is the affordability of homes. So we already went over the prices of homes. They're not collapsing, and those that are sitting on the sidelines waiting for the collapse, you've been duped. It's not going to happen unless maybe if rates hit 9, 10, 11%. But what's going to happen then too is people are not going to sell their homes. So you're still going to have a stagnant market. But then some people might be forced into selling, but there's a limited supply of people on the sidelines, to buy those homes. So that's why you're having basically the dynamics in house values of staying steady. In some areas, people are migrating to still, and they're causing the prices to go up and up and up from there. Okay, so based on this information, we scroll over to the bond market. Now I scroll to the bond market because I watched this right here. This is a mortgage-backed security. It's a bond that trades on Wall Street. The yield on this bond is the biggest component of your mortgage rate. So we focus in on this bond. What's happening right now, you're seeing the bond, it's up. We haven't seen an up market in weeks and months. So what happens is the price is correlated to the yield in an inverse relationship. So let me put this in English for you. If the price of this bond goes up, the yields, your interest rate, it's going to come down. We're seeing a 60 plus tick right through here. The market's up over 60. So we might even see a little bit more reprieve with rates. So I'm expecting rates to come in a little bit shy of here. We might be able to hit 7.6. We might even get into the 7.5 ranges. So if you're out there and you're saying, hey, Dan, okay, now we see the markets, the housing market stabilizing, rates are probably peaked out. Can I afford to buy a house right now? Well, I want to ask you two things. First off, if you've already locked in a rate and you're starting to see rates come down substantially, we'd love to help you. Okay, because what happens is most of the times you go to a bank, you lock in your rate and you're done. You can't renegotiate. You can't do anything. Well, we're a mortgage broker. And we're licensed with over 70 different companies out there. So how this helps you is we can scan the market based on, give me your criteria, what you're looking to do, give me your rate quote. We're going to scan the market to see, is there anything out there better as we see rates decline? So to do that, all I need you to do is upload your loan estimate in that loan estimate tab right up through there. But if you're out there and you're like, hey, Dan, could you help me? I'm struggling. I want to see, are my credit scores high enough? Do I make enough money? Is the down payment money I have set aside right now, is that enough? Well, please reach out to us. We would love to help you. The first step of that is hit the apply now button. What will happen is it's going to ask you a series of questions. The reason why we do that is we want to vet you. Basically, we want to make sure you're assigned to a specialist on my team that can support the exact loan you're looking for. Okay. But if you're out there and you're like, Dan, can I just call you or maybe email you? Well, absolutely, you can. So what you want to do is go over here and go all the way to the bottom of the screen. You're going to see our number, 844-775-5626. I'd love to talk to you. Or if you want to email me directly, just email me at dan@therateupdate.com. Thanks so much for watching, guys. God bless. Have a fantastic day, and I'll see you tomorrow. Bye-bye.